Have you ever wondered how taxes might change when you retire? Typically, when you're working, it's pretty straightforward. You simply pay federal and maybe state taxes on any income you earn as a salary. Unfortunately, when you retire, it's not quite as simple. That's why in today's video, I'm going to break down all the different types of income you can earn and how that's taxed, as well as show you what you can do to lower that tax bill. So let's jump right in and start going through the different types of income you might receive and explain to you how it's taxed. But before we do, let's start by actually understanding which taxes go away when you retire. Now, by the way, when I say retire, I'm assuming that you're no longer working. Some people will retire and still have some part-time work, but the first tax that goes away is what are called payroll taxes or FICA taxes. On any dollar that you're earning as a salary, so as a wage, so not a dividend or capital gain or rent or anything like that, but if you are earning a wage, you have 6.2% of every dollar taxed up to $168,600. Now, on top of this, your employer is also paying 6.2% taxes on all those dollars up to that base. This is how Social Security is funded. Now, any dollars that you earn above that $168,600, those are not subject to Social Security taxes anymore. Now, another aspect of FICA taxes or payroll taxes is Medicare tax. That's 1.45% of every dollar that you earn, and this is uncapped. So whether you're earning $10,000 or $10 million, 1.45% of that is going to fund Medicare. Now, while you're paying 1.45%, your employer is also paying an additional 1.45% on every single dollar that you earn as a wage. So to start, if we're assuming that you retire and you have zero wage income anymore, those taxes go away. So the combined 7.65% of taxes up to a certain wage base, those are no longer being paid when you retire. So what is being paid? Well, what is being paid is federal taxes, and depending on the state that you live in, potentially state taxes as well. But it's not a universal tax rate on different types of income. So let's start to break that down. Now, as we start to dive into the different types of taxes you're going to pay on different types of income, it's really important that you understand the difference between ordinary income tax rates and long-term capital gain tax rates. So I'm going to go over this real quick in the screen. And by the way, I'm going to include this as a free download. So in the show notes below, you'll also have the opportunity to download this if you would like. So what I want you to focus on in this chart here is what I'm looking at here. This is the ordinary income tax rates that you are subject to based on different taxable income levels. So married, filing jointly, if your ordinary income rate is between these thresholds, then this is the marginal tax bracket that you're in. For single, if your taxable income is between these thresholds, then this is the ordinary income threshold that you are in, or the ordinary income tax bracket that you're in. And those tax rates go from 10% on the low end to 37% at the high end. Now, those are different than long-term capital gain tax rates. Those tax rates can be seen here. For married filing jointly, for single, as well as for estates and trust, what you can see is these tax rates range between 0% to 20%, depending upon your income level. So I'm not going to fully go through that, but like I said, this is a free download below if you want to download this so you have access to this as a resource. But it's important that you understand this difference between ordinary income tax rates and capital gain tax rates so we can start to understand how different types of income in retirement are taxed. So with that in mind, now let's start exploring the actual types of income that you might receive. And probably the most common income that people will receive in retirement is Social Security income. At the federal level, anywhere between 0% and 85% of your Social Security income is subject to federal taxes, and it's taxed at the ordinary income tax rate. Now, when I say 0 to 85%, that does not mean that up to 85% of your Social Security benefit is taxable. It means up to 85% of your Social Security benefit is included in your taxable income. So let's take a look at what I mean by that. Let's assume that your Social Security benefit for the year is $10,000. And let's assume that based upon your provisional income, which is the income that Social Security looks at to determine what number between 0 and 85% of your benefit is going to be included in your taxable income, let's assume that the full 85% of your Social Security benefit is included in your taxable income. So you earn $10,000 from Social Security. Let's also assume that you're in the 10% federal tax bracket. What that means is that $8,500 of the $10,000 in total benefit you have from Social Security is included in your taxable income. It's then subject to your ordinary income tax rate, which I'm assuming is 10%, which means you end up paying $850 in taxes at the federal level on your Social Security benefit based upon a $10,000 benefit you received. So effectively, your tax bracket is 8.5% on your Social Security, even though you were in the 10% ordinary income bracket. So that's how you think about Social Security. It is fully subject to federal ordinary income tax rates, but only a max of 85% of the actual benefit is included there. Now, different states treat Social Security differently. Many states don't tax Social Security at all. Some of this is simply because the state itself doesn't levy income taxes on its residents, but some states that have quite high taxes, so California, for example, where I live, California has quite high taxes but does not actually tax Social Security benefits. So this is very much a state-by-state issue, but the majority of states either don't have a Social Security tax or they tax Social Security at a lower rate than you would be ordinarily subject to on other types of income. So what can you do to minimize the taxes on Social Security? Well, as I mentioned, the amount that you pay on Social Security and taxes is based upon what's called your provisional income. I made a video that you can check out right here, where I walk through how does Social Security actually get taxed, what's included in that provisional income. So check out that video if you want to see what I'm talking about here. But in general, most people pay close to 85%, if not the full 85%, of their Social Security benefit, have that included in their taxable income. The next type of income that you might receive is a pension. Now, in general, most pensions are fully subject to federal state income taxes at the ordinary income rates. Sometimes this isn't the case. If you're a disabled veteran and you have a VA benefit, for example, that benefit is tax-free. But the overwhelming majority of pensions, whether they're government pensions or state pensions, are subject to taxes at the federal level. And those taxes are based upon the entire pension amount. So earning $1 in a pension benefit is the same in many ways as earning $1 in salary. The only difference is you're not paying payroll taxes on pension income like you would be on a salary. States, it's a different story. Some states fully tax that pension as if it's fully included in your ordinary income. Many other states have exclusions for a certain amount of pension income, so it's either not included in your taxable income at the state level, or at least it's only partially included. So for example, if you live in California and you have a pension, well, the entire amount is included in your state income taxes. Versus if you live in Pennsylvania, if you're above age 60, then Pennsylvania does not tax your pension at all. So these are little nuances to be aware of depending upon where you live, your federal taxes will be the same, but the state tax implications could be very different depending upon your state of residence. Next, let's talk about interest. How is interest taxed when you're in retirement? Well, first off, I should say it's taxed the same in retirement as it is when you're working, but the type of interest that you're earning is what's going to determine how much of that interest is actually taxable. Let's say you have interest from your savings account at the bank, or you have interest from a corporate bond that you're receiving semi-annual coupon payments each year. That interest is typically fully taxed. So at the federal level, it's fully included in your ordinary income rates. So those are the rates that go from 10% to 37%. At the state level, it's typically included in that income as well, although like I said, some states treat different things differently. But if you have interest from a savings account or a corporate bond or something like that, it's going to be fully included, at least at the federal level, in your taxable income. Now let's say you have a treasury bill. So you're lending money to the US government. Well, that interest is fully subject to federal taxes, but it's tax-free at the state level. Now, being tax-free at the state level, this might be irrelevant if you live in a state like Texas or a state like Florida where you're not paying income taxes anyways. But if you're living in a state like California or New York or a state that has high income taxes, that could be a very interesting benefit because not just the interest that you're receiving on that treasury bill that you're looking at, it's the fact that that interest is tax-free, at least at the state level. So on treasury bills, you are paying federal income taxes at ordinary income rates, but you're not paying state income taxes on that interest. Then you have what are called municipal bonds. So municipal bonds are bonds issued at the state level. Municipal bond interest is tax-free at the federal level. And if you are owning a municipal bond within the state of your own residence, so I live in California and I purchase a bond issued in California, a municipal bond in California, it's also typically tax-free at the state level. So municipal bonds can be double tax-free at both the federal and state level if you are owning a municipal bond within the state that you are also residing in. However, if you own a municipal bond from a state that's not the state of your primary residence, that interest could be taxable. Now here's what you want to be mindful with bonds. If you're owning bonds outside of a retirement account, you want to be looking at what's called the after-tax yield. So if you go look at a bond or an interest rate that you're receiving on a CD or savings account, typically we're looking at that number that's promoted on the brochure or the website or whatever it is. That is a good starting point, but really what we should be mindful of is what's the after-tax yield on that CD or on that bond. Some are subject to federal taxes but not state taxes, while others are tax-free at both the federal level and state level. So don't just look at what's the yield on this bond or the interest on this bond. Understand what's the after-tax yield based upon the type of bond it is and on your individual tax rate to understand what am I getting after taxes. Now I say do that in non-retirement accounts because if you're investing in a bond or a CD or something that pays interest inside of a retirement account, well, all that interest is either tax-free or tax-deferred depending on the type of an account that it is. And this is really important to know because a lot of clients will come to us and I'll see that their old advisor put municipal bonds in their Roth IRAs or their traditional IRAs. And we'll look at this and say, why on earth would we do this? To own a municipal bond, we are accepting a lower yield than what we could get on an equivalent type of bond that's not a muni bond. So why would we accept a lower yield if we're then going to stick that in an IRA or a Roth IRA where it's tax-free or tax-deferred anyways? So make sure that when you're owning bonds, you understand which account type is best to own it in and then which bond type is best to own based upon what your individual tax situation is. Next, let's talk about dividends. So the taxation of dividends depends on whether it's considered a qualified dividend or a non-qualified dividend. If you have a qualified dividend, then it is subject to those long-term capital gain tax rates that we looked at the beginning of the video. So anywhere from 0% to 15% to 20% depending upon your actual taxable income. Now this is a great benefit because those income rates or those income tax rates from 0 to 20% are a lot lower than the ordinary income tax rates, which range from 10% to 37%. So the more of our money we can have subject to long-term capital gain tax rates, the better, generally speaking, all else being equal, than it is to have those subject to ordinary income tax rates. I say that because not every dividend is a qualified dividend. Only qualified dividends are subject to that tax bracket. If it's a non-qualified dividend, then that dividend is fully subject to ordinary income tax rates, which are the ones that are taxed between 10 to 37% at the federal level. In order for a dividend to qualify as a qualified dividend, you have to have held it for 60 or more days during the 121-day period before that stock's ex-dividend date. It can get a little confusing, but essentially you have to own that stock for a certain period of time in order for the dividend that you're receiving from it to be qualified as a long-term capital gain in terms of the taxation of that dividend. Next, let's talk about those actual capital gains. So let's assume you own a stock or a bond or any type of investment that's held outside of a retirement account. If that investment increases in value and you then sell it, that is considered a capital gain. So what's the capital gain tax rate? Again, it depends. If it's a short-term capital gain, so anything held for 1 year or less, you are paying taxes at ordinary income rates, 10 to 37% at the federal level. If it is a long-term capital gain, then you are now paying taxes anywhere between 0 and 20%. So if you're holding that investment or if you have held that investment for over a year, your tax bracket goes down when you ultimately realize that gain. Now this is where you need to be very careful about the types of mutual funds that you're owning outside of an IRA or Roth IRA. Again, I'm saying outside of those, not because it doesn't matter inside of an IRA or a Roth IRA. It absolutely does for performance reasons, but not for tax reasons. If you're holding a mutual fund outside of a retirement account, you might hold that fund for 2 years, 3 years, 5 years and not touch it. But if internally within that fund, the mutual fund manager is constantly turning over your portfolio, buying and selling stocks, buying and selling bonds, buying and selling whatever securities are owned in there, and they're not holding those securities for the 12 plus month holding period, well, they're not paying taxes on those short-term capital gains. Those are flowing through to you as the investor. So be very mindful of what's called the turnover within your mutual funds held outside of retirement accounts, because even if you think you're being a good disciplined investor by holding something for over a year to qualify for long-term capital gain tax treatment, well, the internal turnover that's happening within the fund, that gets passed along to you as the investor to ultimately pay the tax bill on. So make sure that you're mindful of that when you're selecting the funds that you're going to invest in outside of retirement accounts. Next, let's talk about Roth IRAs. Thankfully, Roth IRAs are one of the easy ones. In general, you're not paying any taxes if you're taking money out of a Roth IRA in retirement. Now, this must be a qualified distribution from your Roth IRA. I'm not going to go all the ins and outs of that, but I did a podcast here that you can access. This podcast will walk you through what qualifies as a qualified distribution from a Roth IRA. But assuming you meet that definition of a qualified distribution, that income is completely tax-free, which is an amazing thing to have in your retirement. Next, let's talk about IRA distributions, so traditional IRA distributions, which could also include traditional 401k distributions. Any money that you pull out of a traditional IRA or traditional 401k is fully subject to federal ordinary income taxes. Now, the money that's in your IRA or the money that's in your 401k, even when you're retired, that continues to grow tax deferred. So it's not the total balance you're paying taxes on, it's just whatever amount you pull out. So if you have $1 million in your IRA and you only pull out $10,000, you're only taxed on $10,000. If you have $1 million in your IRA and you pull out $1 million, well, you're taxed on the full $1 million. So make sure you're being mindful of how much are you pulling out each year, because one of the things you can do to decrease the taxes on your IRA is to implement a good Roth conversion strategy. A good Roth conversion strategy allows you to control the timing of when you're actually pulling money out of the IRA, and not just pulling money out to keep in your checking account, but typically pulling it out to then convert to your IRA, or your Roth IRA, I should say, where it then grows tax-free. Qualified charitable distributions are another great way to decrease the tax liability on any IRA distributions. So I have other videos on this channel that you can go and look at where I walk through that in more detail, but those can be excellent things that you can implement to decrease the tax bill on your IRA distributions. So that's all at the federal level. Every state, just like I said before, has different types of ways that it will tax IRA distributions. Some states fully include those distributions in your taxable income. Other states will exclude a portion of the distributions from your IRA from taxation. Some states will fully exclude that from taxation. So depending upon what state you're in, talk to your financial advisor, talk to your accountant to see how will those distributions be taxed when you pull that from your portfolio. Next, let's talk about rental income in retirement. So you have a rental property, you're collecting income there. That income is subject to ordinary income tax rates at the federal level, but only the net income. So if you're renting out a property for $2,000 per month, you're not paying taxes on that full $2,000 each month in federal ordinary income taxes. What you do first is you deduct any of the expenses involved with that property. So what could deductions look like for a rental property? Well, this could be mortgage interest if you have a mortgage. This could be property taxes that you're paying on the rental property. This could be any basic operating expenses with the property. This could be depreciation. Now, depreciation is a big one because it's not actually a cash expense. You're not actually paying someone depreciation and then writing that off. Depreciation is just writing off a certain portion of the building expense each year. It's kind of like a phantom expense, but it's saving you money in taxes. Now, there is depreciation recapture if you later sell that property, but depreciation allows you to deduct some expenses from the property that you're not actually out of pocket with when it comes to paying for them. Whatever's left after all that. So if you rent it out for $2,000 per month, but then you have mortgage interest, then you have property taxes, then you have depreciation, then you have all these other expenses associated with the property, whatever is left, that is what's subject to ordinary income taxes at the federal level. So those are the big types of income that you're going to be paying taxes on in retirement. Now, a couple things I'm going to include as an honorable mention. They're not necessarily income taxes, but they are taxes that you need to be aware of. The first is what's called net investment income tax. This is assessed on things like interest income, dividend income, capital gain income. You only potentially pay this income if your modified adjusted gross income is above $250,000 and you're married, or it's above $200,000 and you're single. The numbers for this are actually on the cheat sheet that I mentioned above, but this is something to be mindful of. So sometimes when you're thinking about taxes on things like rental income or dividends or capital gains, yes, look at federal taxes. Yes, look at state taxes, but you might also potentially be subject to net investment income taxes, which is an additional 3.8% on some of that income. And then the other thing to be mindful of is what are called IRMAA surcharges. So IRMAA surcharges are the extra amounts that you might potentially have to pay on any of your Medicare premiums. So when you retire and you have Medicare, you pay a premium for Medicare Part B and Part D. And there's the base level premium that everyone pays. But once your income starts to exceed certain thresholds, you may have surcharges on those premiums. Those surcharges are listed on the important numbers fact sheet that I mentioned above as well, but something else to be mindful of. Not traditionally a tax, or not thought of as a tax in the traditional way like other income sources are at the federal level and state level, but it's something where the higher your income is, the more you're going to be paying, so in a way, it is like a tax. So these are all the different ways that you might be taxed on various income sources in retirement. This can seem quite overwhelming. So the next step isn't just to understand how are these different income types taxed, but how do I start to think about where I should pull money from first in retirement based upon these different tax rates. So if you're wondering that, well, I made this video here, and what this video is going to walk you through is based upon the portfolio that you have, and based upon your tax situation, where should you begin to pull income from first in retirement to ensure you're minimizing the tax bill that you owe? Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.